was just like running around drinking that, and we knew that we had lost, right? So we basically said, hey, maybe let's try to pivot to do our product as a mixer for cocktails. But then, when you start to do certain things that are kind of like, you just know it, right?
Thank you so much for tuning into Journey with Christian Diava's podcast. I'm your host, Christian Diavas. This next guest is the managing partner at Fairbridge Park. Now, they're passionate about working with brilliant mission-driven entrepreneurs who are proficient at team building, product and operations, add value through providing venture and growth capital, strategic technical support, and bring in executive experience in matters such as governance help, recruiting, connections to network, and being a trusted, steadfast partner. And of course, what most founders probably need is someone in their corner, a cheerleader, to say, hey, keep going, rock and rolling. Please welcome my next guest, the one and only David Tswamuno. How are you doing today, David?
Hey, Christian. Good morning. I'm doing great. Thanks for that kind introduction, and I'm happy to be here.
Well, David, I'm really looking forward to this because I was looking at, obviously, a lot of your content at Fairbridge Park. And one of the things that I found so interesting about your thesis is you guys really focus specifically on tech-enabled businesses delivering effective, capital-efficient solutions to underserved consumers in the foundational areas of economic wellness, health, and the environment. And before we dive into all your investment thesis, I want to ask kind of your story, your journey of how you came to say, hey, this is what I want to stand for. This is my thesis whenever we invest into a company and a founder.
Yeah, it's a great question. It's a bit of a winding story, but I'm going to try to be as succinct as I can. I think I grew up very poor. My parents were social workers. My dad is a pastor in a church. And so the idea of serving and doing things that matter to others was always just top of mind in how we were raised. And I think when I sort of grew up, I knew that, and I realized I really liked finance. I knew that I wanted to find something at the intersection of capital and serving really meaningful things. And I just didn't know what it was then. So I kind of winded through and was working on Wall Street and realized that that's not what I wanted to do. And then a friend of mine said to me, hey, what you're describing is venture capital. That's when you have money and you sponsor like really good ideas. And so why don't you apply to Stanford? Because that's where people really learn how to do venture capital. So, and she kind of helped me out and I ended up at Stanford. And sort of from there, it sort of took off. I joined the family office after business school, and they were really serious about investing in things that matter. So they were pioneers in investing in organic food, low calorie options. And I was like, oh, okay, this kind of works. You can kind of choose your lane and choose things that matter to you and invest capital in them. And fast forward, I think I kept getting a sense that I wanted to do something a little bit more meaningful and deeper in terms of the topics I wanted to sponsor. And that's how Fairbridge Park came to be. And so if you look at the companies we invest in, they're highly profitable businesses, but they're serving an actual need in those core areas. I call them foundational areas. And in some ways, our companies are building resilience and helping people maybe fill some of the gaps that maybe, nonprofits or governments or other institutions that are maybe tasked to do this or expected to do it may be insufficient. So we try to find those kinds of entrepreneurs and companies and invest in them fairly early. So this is just aligning with my values and my skill set and what I really think the world needs at this point.
So David, let's unpack this a little bit further because, what I found interesting is that you guys aren't really focused on impact, world, but it's really interesting because you guys talk about economic wellness, health, and the environment specifically in regards to your thesis. And there's so many different subcategories that are in the ESG world, impact kind of investing strategies. And I want to ask, David, how did you guys come to that conclusion where you're like, hey, I want to focus on economic wellness, health, and the environment when we're looking at companies, founders, proof of concept, things like that?
Yeah, I'm a stickler for storytelling. I think that, I moved to the US for college in 2002. And when I moved here, I had I was very fortunate to be invited by a lot of my friends to their homes, and I would go there for Thanksgiving, for Christmas, for a bunch of holidays, and and over time, you could see that some of the friends, their families, their position in the economy really started to deteriorate. So I moved to the US in 2002, and by say 2012, you could see that there was a decline in what if you sort of look at the Maslow hierarchy of needs, some of the very fundamental requirements or needs of people basically having safety in your finances, being able to afford your healthcare, and the environment is sort of interesting because it impacts everything, right? So if the environment is not working properly, then you have other externalities that can impact your ability to earn a living. So it sort of is a catch-all. And so I think with just looking at that, I just realized an opportunity that, hey, look, people are struggling. People are doing 1099 jobs. They are no more like pensions. People, some of the safety net that were provided by corporations, like pensions or maybe subsidized education or some of those other things don't exist anymore. And I think the private markets and capital markets and entrepreneurs always come to save America. They always come with solutions that can help to ameliorate these problems. So I wasn't really looking at it from a kind of subsidy or impact or separate from just commercial interest in solving important problems. And I think that is a key thing that differentiates our business is we look for entrepreneurs that authentically care for these problems with a very strong commercial mindset. So when people start to ask me, what is the trade-off between impact and return, I just think that's almost like I wouldn't call it a non sequitur, but a false trade-off. So we don't think about things that way. But we really like to.
So this makes sense.
Yeah, please go ahead.
No, I was just saying this is awesome in the way you kind of structure this. I want to unpack this a little bit even further because what I love and what I get excited about is that there's this conscious capitalism where it's that impact side of things. And I think that's, I know that in order to solve these big problems, you have to do it in the private world, right? Where you have to own some companies and they have to produce an incredible return, but also, make an impact. And I'm curious, Dave, because like you mentioned, you do have some really cool companies, Select Investments, I may mispronounce them, Expectful, Roots Food Group, and so many others, and some of you've exited as well. And David, when you're looking at, because what I've noticed is that you don't have like a specific category, not like specifically in SaaS that are in economics, wellness, health, and environment, or you're not just specifically in pharma, right? You focus on kind of a broad industry agnostic, but also like as long as it aligns with these larger topics and thesis. So David, when you're looking at something, how do you look at it? How does Fairbridge Park, how do you guys kind of unpack the due diligence, the founder, and saying, hey, what is this market and the possibilities behind this?
Yeah, so I'm gonna sort of unpack that for you a little bit, take a step back. So ultimately, I learned how to invest as a consumer investor. So I'm looking at companies that have a benefit to an end consumer. So I'm looking at investments from a consumer lens. And within the consumer category, there are sort of widgets and the software tech enabled. We try to we're agnostic because I grew up investing in manufacturing plants and real physical products, but over time also really started to understand consumer services and products as well. So within that framework of the fundamental areas, our pillars, which is economic health, health and wellness and environment, we're looking for consumer businesses that have an outsized impact on how consumers' day-to-day lives are. So we call that, the word we use is resilience, really. And so we have a thematic lens when we look at companies. So in this Fund One, one of the areas that we are looking at deeply, and if you look at the companies on our website, they are providing help in access to credit, in really helping people to optimize their cost of capital and in democratizing. So if you look, there's a company called Sora. Sora, what they do is you basically give them a social security number and they can go into all your liabilities, and they have a tool that is consistently always on and looking to lower your interest rates. And an average person in America is probably looking at who's looking to buy a car is just being given a paper at the dealership with an interest rate. They don't even know how those people were selected. So our goal across in that sort of pillar as of now is just to really help people find access to credit, help redefine how people access capital and make their lives easier. And when you go to healthcare, you see that we have companies like Expectful, we have Roots Food Group, and the idea is access, especially around people that are marginalized or need the services and cannot afford them, focused on what we are calling critical services. So Roots Food Group is helping people with chronic diseases to access food as an alternative to medicine, and simultaneously covering the concept of the problem of food deserts and food insecurity, because most of those people do happen to also not have access to like food in general or grocery stores. And then if you look at an Expectful, the idea is to help reduce, improve outcomes for pregnant women, which is something that disproportionately impacts lower income people or people of color. But all these are very commercial businesses, very high margin, have a lot of customers. So as we sort of like go over into Fund 2, we start to think about and look at new trends and new themes, and then we focus on those themes. One of the themes I'm looking at right now is just the future of work, how to really position people to earn as much as possible through like training or through repurposing. And we're starting now to look at, hey, how can we help people be economically viable through just helping them with getting better skills, upskilling.
Okay, and see, let me ask you this, because I've heard this where when you're walking through this kind of thesis, and you see that kind of focus with these companies. When you're looking at this, because you guys do invest in that pre-seed, Series A kind of structure a little bit, so a lot of times that's pre-rev, sometimes in that category. So David, when you're looking at this, when you're doing your due diligence, how much emphasis do you put on the founder versus the actual projections and possibility of like go to market? The market penetration, market, possibility of acquiring some of that, just the growth trajectory of the company. Because at that point, they don't have any, revenue. Maybe they're just developing the product, et cetera, et cetera. So when you guys are doing due diligence, what do you guys emphasize the most to say, hey, you know what, we're going to mitigate this risk because we know that this individual's had, 2 or 3 exits prior. So we know that this founder is also not only had previous exits, but also very passionate about this project, et cetera, et cetera. Help me understand how you guys look at that.
Yeah, so there are essentially 3 ways that I look at businesses. And number one is the people and the team, just the infrastructure of brain power and resources around the business for execution. So the good thing about the work that we do is we are looking for mission-driven entrepreneurs, and it's much easier to see what doesn't qualify and what qualifies, because the problems you're solving are, it's either it's in or it's out, right? Because they're very specific. So I would not invest in a company that is, hey, how many calories should I eat today? Because I'm looking at a certain level of significance. And so people that are trying to solve these problems do tend to self-select. And it's also easier to investigate authenticity, to investigate track record, and to investigate then their commercial sense and ability to execute. But ideally, since we're investing pre-seed, one of the things that we're doing a lot is spending a lot of time mentoring, getting to know people, and really putting in what I call sweat equity to understand what they're doing, to seek that alignment and to seek that authenticity before writing that check. Now, when it comes to the business model, business models at this stage, there's a certain problem we're trying to solve, and there is an approach that we are taking that and a certain hypothesis for how that's going to translate into product market fit and economics. Things don't necessarily, when the rubber meets the road, all things go wrong. That's the first thing that happens, and then you sort of like navigate. So one of the things that I'm looking for in entrepreneurs outside of authenticity is the ability to manage venture risk. Are they able to navigate difficult things, see what's working, what's not, adjust, and still be able to make progress within the time frame that our money affords us? So which takes us obviously to the second thing, which is, I call it survival, because it's the easiest way to describe it. But it's, is there something that is unique about the economic model that provides high economics Or is there something about cash burn that is helping the company to stretch the resources that we have over a longer period of time to be able to run these experiments quick and find some enterprise value that somebody else is willing to pay for down the line. And then when it comes to the business itself, then we're looking at, is it solving an important problem? Is it defensible? And does it have like a certain ability of generating superior economics and at scale? So those are like the three things: survival, the team, and the business itself in terms of what really differentiates it. Can it be a category leader?
So, this is what I find so interesting because, at this point, what I'm looking at is like when you're at that, you go to market strategy, and I'm curious, when you see something that's not working and it's not scaling to the level that you're like, are there certain red flags when you're seeing this, in the second or third year that you've got this company rock and roll, maybe they're at Series A situation and they got some money going, but are there certain red flags that say, hey, we have not hit this, this key metric in this timeline? That's a red flag. Why aren't we? What's going on? Let's reverse engineer. What can we do to make sure that we obviously are on the right track? Because obviously I do understand that in a lot of VCs thesis, it's like 5 to 7, maybe 10-year kind of structure out, and then there's an exit at some point. Some are longer, some are shorter, et cetera, but that's kind of what I'm looking at. So David, are there certain criteria, there's certain key points, there are certain hurdles that you like to see this company hitting in the allotted time frame? Otherwise, that is a red flag for you and your company.
Yeah, it's on a case-by-case basis. So I define companies in terms of when the reason I like to invest early is because you can influence the culture of a company, the personality of it, and also just how it's executed. And one of the things we do with entrepreneurs I work with is we have strategic milestones, and then we have operating milestones, and then we just have like points of reassessing all those. So sometimes, I also believe that strategic milestones can lead to enterprise value creation. So if somebody does something that gives them an unfair advantage, they lock in some supply, all those things, they help. And then now you get to a point where you have to execute and have some metrics. So what's happening normally in this business is we are trying out certain things, and we're trying to see whether there are other metrics that are sort of secondary metrics of showing uptake or interest, or like a funnel or like a pipeline, and then how that converts. So when those conversion ratios, so when the pipeline is not building, is not coming together, then you know that, okay, maybe people don't want this. A second scenario would be people want it, but maybe you have to adjust pricing, or maybe it's not accessible, or maybe it's not in the form that they expect. And then the third thing is it just fails. It doesn't work. Venture has a very high failure rate, and I think one of the lessons I learned, having been in this industry for a while, is it's also fine to say, hey, here's what we wanted to do, and here's the experiment that we ran, and understanding exactly what you did, and say, hey, it didn't work, and then saying, how do we minimize or mitigate loss of capital if possible, or how do we as a fund now reallocate resources to all the little companies we have that where we think that that development is much more stronger, there's much more of a spine. So there's also a portfolio management layer to allocation of resources. But I think if you know people and you have started with them early, and you have that level of transparency and trust, and you can also just say, hey, look, guys, we tried, it did not work. How do we reorg? Do we need to do this within the same organization? Do we need to release the resources so they can go somewhere else where they're much more efficiently used, or do we need to retool everything completely? So it's also on a case-by-case basis, but having the humility to agree or understand that something is not working early is also part of winning in venture capital.
Can you give us a case study of something happening like that? Because I find that so interesting, where it is so contextual, and I definitely get that. And that's why it's hard to understand, but it's like, really seeing this company and saying, okay, hey, we've been at this for 4 years. Maybe we haven't seen, positive EBITDA, or maybe we're not positive growth or whatever. And there's certain like red flags. You're like, okay, well, we got other people, other companies in our portfolio that are scaling, cranking, rock and rolling, hitting those KPIs, hitting those strategic, focus points. If you could maybe just give us a case study or a situation where you're like, okay, this is what it was contextually. This was the story and the data that was explained to us. And so we had to go ahead and pivot and readjust and portfolio management, because like you mentioned, you do have to, focus on the returns, but also mitigate those losses.
Yeah, I'm gonna, not tell you the names because I'm probably not allowed to, but I'll give you an example of, in my previous life, we invested in a company that was really a pioneer in making alternatives to sodas like Coca-Cola, Pepsi with low calories, and it was obviously a brilliant idea in the sense that people were starting to really question whether how much sugar you should have, and that was becoming a big topic. And so our drinks had like I think 80 calories or something. A soda has 140 calories, and then like anything else, you're gonna get copied, and other people are gonna want to do it. And we sort of realized that we had initial growth, and then we kind of hit a peak, and we said, okay, so what do we do here? Maybe let's do new flavors and let's do new innovation. And we tried that, and sort of went up a little bit, and then it kind of hit another peak. And all this time, you're also looking at how much capital you've invested in a business up to this point, and kind of how much of how big does the business have to be for you to make a meaningful return? And you're sort of measuring that, and you're getting in the hole deeper and deeper, and you're like, okay, should I stop now? And what basically eventually killed us was that those companies like LaCroix and Spindrift just basically said, hey, screw this, let's just make a 0-calorie option. So they just took it all the way to 0, and we're playing in this 80 to 60, we're like 60 to 40. And then everybody just started like buying those waters in offices, and everybody was like running around drinking that. And we knew that we had lost, right? So we basically said, hey, maybe let's try to pivot to do our product as a mixer for cocktails. But then, when you start to do certain things that are kind of like, you just know it, right? You know that at this point, maybe this is not working. So that discipline of understanding and looking at the market dynamics, I think that's another component maybe I didn't mention, which is there are also things that are happening. Venture is an interesting business because it's an opportunity cost and a relative business. Other people are doing certain things, and when other people just do it better and the market is sort of saturated, maybe you just bow. And this was also just a situation where we sat down and we said, okay, this is not going to be successful, and we've tried our best. This is what we did. This is what we could have done better, and it's great. Let's move on.
I appreciate the authenticity of that, because it's one of those, what I found so interesting, I see this in the wealth management world, it's that psychology. When we're already in loss and we're already, having that loss, it's hard to just accept, right, the loss. And it's easy to say, well, you know what, I'm going to dollar cost average or something like that in the investment world. And I'm going to put more money into it because I'm hoping that if we would just put more money into it, then we'll be able to scale it. And because we see the power, we're like psychologically invested. And that's why I think it's interesting to hear, like, okay, hey, when do you, because it's so contextual, because in today's society, it's always like, never quit, never give up, right? But the reality is sometimes you do have to cut your losses. And the faster you can cut the losses, then you can focus on the winners, double down on those winners, triple down on those winners, and see that up to the right trajectory. So I appreciate it helping me understand how you guys look at that. There are certain safe boundaries that you say, okay, you know what, if we go beyond this, if we put everything that we've got into it, into this founder, into this company, and we still haven't seen growth or whatever, and there's certain, strategic, metrics or whatever, and hasn't hit that, then obviously we have to reallocate our portfolio. I want to ask you a little bit also on, David, when you guys have this approach where you guys are activists, okay? You're very steadfast partners, leadership academy, and you're also kind of very ambitious and coming alongside them, really giving out your ecosystem and your network. And David, when they hit mass scale, now we're talking about when they're at 8 and 9 figure kind of run rates, maybe mid 8 figures, okay? Do you guys help in the talent acquisition, building out the systems and process and operation as well? Because you want, at the end of the day, it's not only about selling more product or selling whatever that is, that service is, but there's also that talent acquisition to ensure that they can anticipate and they can run with the growth once they're hitting mass scale. How do you guys see that when they're at that stage?
Yeah, so I'm investing mostly pre-seed, maybe seed. very rarely Series A. And that one of the reasons why I wanted to do this was because I really like to work with the protagonists, the founders, the people that are have the idea, that are running it, and being as close as possible to them. Now, when a company is doing a Series A, we are most likely taking our pro rata if there's been success, and then other bigger firms are coming in, and when the bigger firms come in many cases, they really want you to know that they've arrived, and they want to sort of take the agenda. So normally around that time, we have a certain influence that is more moral, that's more personal, emotional, that is not necessarily running is not in the documents, right? So it's not in the documents where they say there's going to be this board member and there's going to be this person. I'm normally not sitting on any boards at the time, or nobody in our organization is. However, we, those first few hires really define the culture, right? So if a guy is founding a company, or there's two guys, they hire a third person. Now 33% of the culture is coming from the outside. So we are really, we are very a critical partner in the formation phases where all the DNA of the organization is formed. And then as these companies grow, so like some of my CEOs that I work with now that are like in Series A, Series B, I probably, I wouldn't say this out loud to the bigger firms, but I probably spend more time with them about talking about the business in a very sort of maybe not therapist, but trusted partner way than say a board member that has like a title and is saying, where's my money kind of. So in terms of like hiring, we are really, I believe in that critical phase where we're helping a CEO hire somebody, not because they're really competent, but because they believe in the mission, because they can work together, because they trust them, because there's this fit. And that's normally where we are coming in and evaluating these people and saying, hey, look, I know that you're this kind of person. I don't know that this person is compatible with you. I don't know that this person is, whereas like, I think when you go down further, you're using headhunters and it's a bit more process. So I've spent so many times in coffee chats with CEOs of companies and people that they want to hire, that they refer to me, and I spend maybe 2 weeks just kind of stalking them online and trying to understand whether they would be a good addition to the company or not. So our work is activist in a, maybe not in a cow icon or Paul Singer way, but really in a, I would almost call it like invasive. There's almost sometimes no really good distinction between the relationship between like how personal it is and how professional it is. But we understand how to navigate that.
That makes sense. That makes sense. Yeah. And no, when you're looking at an exit, what is your guys' philosophy on that? I've heard SPACs are really, really sexy right now. I know IPOs have dropped down tremendously from what they used to, and I know acquisition tends to be kind of the smooth transition. But what is your guys' like focus? And I know it's very contextual again, but I would love to do you lean more towards IPO because hey, you know what, that's hands-off approach, or more of acquisition, or when you guys are looking at exiting, how do you guys look at that? Are you guys saying, okay, when we put money into it, once they hit this level, 3 years down the road, we're going to start collaborating with other, individuals that are looking to maybe potentially acquire this, right? So, kind of anticipate where the hockey stick or where the puck is going in the future. 3 or 4 years, we're going to have this conversation. Once we hit these certain levels, then we can get acquired and they can get acquired. What is your guys' perspective or paradigm around that?
Yeah, it's a great question, Christian. I think exits are outputs. So I know that we sort of have in our memos what is the exit return profile and like how is the company likely to exit, but exit is an output, and so if the inputs are right, you succeed. And outputs kind of happen in a spectrum, so it's harder to really understand which output you're going to get. But I think the quick way to think about it is we want to invest in companies where we think they're going to be category leaders. So there's a big enough market. So when I look at a business, so I have a Seal the Seasons, one of the companies I invested in, they're basically building a locally distributed network of supply chain network of to buy all the local produce in America. So now if they take over all of America and they build these little supply chains and have relationships with all the farmers in the US, that's a massive company. If that happens, now that we're going to have a public company that has a local supply chain and is sourcing and selling all the produce locally, that's a public company. But from time to time, the company gets acquisition offers from other players in the market that are like, hey, I really like this, locally sourced, working with local farmers. How much money do you want for me to buy the company, right? So what the takeaway from those two things is, we're building assets that maybe somebody else who is in the market, just based on the kinds of companies we look at, says, wow, this company is really an innovator in my space. What do I need to pay to get this company to fill this white space, right? So if somebody is buying produce from Latvia and they're like, okay, the supply chain scenario there is just bad, or I really want to promote locally grown, they will come and approach us and say, can I buy your company? And then we discuss it with the group. Or if that doesn't happen, we have enough capital to continue to grow and go down the path of being like a big company. So they're sort of, again, opportunity cost trade-offs and how much more do we want to go. And then from a fund perspective, obviously we are limited by our resources, our budget towards a specific company. And what we are trying to do is obviously buy the cheapest and hold the longest if we think that a company has what it takes to go all the way. But maybe we are only able to continue to put up money until like a Series B or maybe a Series C. And then from then on, we take on dilution. But as we take dilution, now we say, how much bigger is the pie and how much smaller is our percentage ownership going to be? And are we comfortable? Do we want to have a small portion of a really, really big pie? Or do you want to have like a big portion of a small pie? And you sort of then calibrate just based on certain assumptions and knowing the company and knowing what is ahead of you in terms of open space for growth. And also just looking at the partners at the table, like who is the big firm that is now writing a check to this company? Do we know them? How have they treated other partners in the past? And do they just like, what is their strategy? So it's a very complicated way, but we at the very least, we want our companies to have three things. Number one, be really attractive to somebody else, have enough size, ambition, and capacity to be like an IPO. And three, own your own destiny. Have a path to profitability. And if things are not going so well, don't have to raise more money. Hang on tight, reinvest your proceeds, and figure things out, and improve your chances of winning.
Let me ask you, and I get where you're coming from in that regards, because it's like you'd rather have 2% of $1 billion company more so than 30% of $1 million company, right? It's that context. Now, David, I want to talk a little bit further in regards to the dilution aspect. In the way, is there kind of like a paradigm? Is there like a comfort zone that you'd like to be in, and saying, hey, you know what? Once they hit that $1 billion, it's okay to anticipate a 1% or even a 0.5% equity portion, because you're getting a large portion of it, and it's valued at a higher ratio? Or is it more of like there's kind of like at that 9-figure rate and you're like, hey, 20, 22%, et cetera, 10%, whatever? How do you look at that? Unpack that a little bit further for us.
Yeah, if you talk to some of the very technical guys, they'll tell you very specific numbers. I know those numbers, but I want to like move away from necessarily looking at it that way. I think for me, the most important thing about any company is runway. How much money do they have, and how much time do they have to create value? So like, what is in a company that I am today, and they have cash for 24 months, how much enterprise value are they going to create in that time frame? And that is usually the decision that I'm using to then calculate in the back whether dilution is okay or not. And the cash burn of a business is partly structural in terms of you just have expenses, or maybe you're like you have a manufacturing plant or something, or you have high working capital and you have to spend a lot of money, or you're just you have AWS and a bunch of guys and you spend $100 a month or something, or it's also a function of like philosophy and culture and other stakeholders. So there are investors that will come in and they say, hey, let's just pump the gas into this and like let's take off, let's go all the way. And then there are other investors that are much more cautious. So when we look at dilution, we're looking at it really in terms of like what is structural in the company and who else and how is the company thinking about growth and spending money. So in companies where the cash burn is so high and that we lose comfort in their ability to use these little resources to grow enterprise value, we want to hopefully keep a high exit when we still have a high number of ownership. But where we see that there is just a bit of a discipline, but where we also see that the path to value creation is a little bit efficient from a capital perspective, we're okay with dilution.
See, David, this is actually an interesting conversation because within the last 7 years, we have seen just this massive bull run. And it's interesting because I've noticed a lot of companies that hit $1 billion valuation, but they're actually not positive EBITDA. They're just burning ridiculous amount of money to be able to kind of infiltrate it because the capital is, there's so much capital in the markets. So David, what is your opinion? Because I like what you said in regards to like, there are certain other kind of contextual metrics that you're looking at to say, hey, what does that dilution look like? And say, is this the best value for it? So when you're looking at scaling and you're hitting mass scale with these companies, okay? And like I mentioned, coming back or looping back around with certain metrics that you're looking at these companies, do you like to see positive EBITDA when you're exiting? Do you like to see, these certain, like you mentioned, there's a certain amount of cash on hand to have a good runway, to be able to anticipate whatever's happening. There are other things that are happening or other metrics that you're looking at to say, hey, you know what, this is kind of a good foundational business. Because correct me if I'm wrong, it's very interesting to see, how these companies have hit that several $1 billion valuation, and they're like not positive EBITDA. It just blows my mind. But mainly because there's just so much capital, they just shove it into the machine.
Yeah. And that's a very good observation, Christian. I think what you're like alluding to is also just a function of the pie chart of capital allocation, right? So in the past few years, other asset classes were basically maybe not really viable. You couldn't really invest in credit if the interest rates are so low, because then you don't make a return. So just over concentration of money into equities and then. So a big part of this is really supply and demand, right? So it's underwriting standards are low and loose if everybody wants to invest. So there was a time I remember, not too far ago, when a company would call you and say, hey, I would like for you to make the decision to invest by tomorrow or something like that, because they had so much money. And now at a bigger scale, to your point, which is a company can have a valuation of $1 billion and not be profitable. I think ultimately companies are judged by their ability to produce cash and to provide a return to the investors. Now, for me, who's somebody who's investing really early in a company, and sort of going back to the point we were discussing of strategic achievements and operational achievements that all come into that enterprise value. A company could have somebody could ascribe certain value to something that is not necessarily cash today, but that could be cash tomorrow. And I think some of what got inflated, if you look at like how companies, how valuations got inflated, it was really multiples, and multiples are usually a certain prediction of expectation of how the ability of this company in the future to generate cash flows. And I think people just got too excited and then didn't really diligence. So I remember companies saying, hey, writing articles and celebrating that they just became unit economics positive, which means they just turned a profit on gross profit. And that being something worth celebrating. And I'm looking at it, I'm just completely floored by how ridiculous that is. But I think now, as the resources are becoming less and other asset classes are becoming viable, the opportunity cost is high. So I think we are now seeing a little bit more those sort of predictions and the probability that people put, or the expectation or the pressure for companies to quickly translate all those metrics into like an actual number of money that can be either dividended out or reinvested. that's becoming much more tight. And that's just really how companies should work to begin with. And so, for us, we like our companies to be profitable very quickly, to have high unit economics, because it buys us the option to continue to do the work that we want to do to grow the company. So it's also almost self-serving in that sense.
So the last few years, everybody's been living in a fictional world and this stratosphere kind of lifestyle. And the reality is we're getting back to baseline, which is good. And, we're going to build some really foundational businesses, which is really interesting to see. And I like that approach, because it is interesting to see the multiples on some of these companies, even FBA, fulfilled by Amazon. I'm saying, like, what kind of multiples are you guys, selling at? It's unbelievable. It was just
Yeah.
stupid. It was like FBA
Yeah.
too, and you're relying on there were a lot that you were relying on, but with their supply chain. But anyways, I appreciate your kind of thesis on that, and I really appreciate your perspective, because it's very unorthodox, and I'm so glad to see that the whole industry kind of coming and pivoting right back. Now I want to ask about your portfolio companies. Okay, so there's ups and downs, and I've heard some individuals where they kind of shared their portfolio and said, hey guys, talking about burn rate, talking about runway. David, what are you kind of sharing with your portfolio right now? Are you saying, hey, anticipate 2025 runway, making sure you have enough cash on hand to be able to anticipate this, run a stream, a very streamlined shop to ensure that you're able to, withstand this time, whatever it may be. But you've been through a lot of different markets, David. So I'd love to get your perspective and response in regards to, like, what are you sharing with your portfolio right now, your portfolio companies, to say, hey, this is what we're seeing holistically.
The big thing right now is just the price of money. People have now understand that money costs something, so you're not going to get it for free, right? You're not going to get money just like that, because people understand that they could put it somewhere else. So we have always impressed on our companies the value of financial discipline and the value of building things that matter, right? So just by selection, naturally, every business that is in our portfolio is doing something that, if you just heard about it and you didn't see the company, you would be like, wow, this is so grand, this is so good, right? But then underlying, these are also really strong businesses. And what we try to, and this is my just personal philosophy, and maybe just have to do with my upbringing. The message is always survival and more runway with the least possible dilution. So a lot of our companies, there's a certain adverse selection that is happening right now, where a good company probably gets people coming to it and saying, hey, are you guys looking to raise money? Like, people are looking for those kinds of bargains, right? So I have a few companies right now where some investors have approached them and they're like, hey, I know you did a pre-seed or a seed. Are you looking to extend it? And what are the terms? Can I invest at the terms that your other investors invested in like 6 months ago? So what we are doing is be opportunistic. If you can find capital from somebody that really likes what you're doing, and somebody that you've been talking to, and they can give you, 6 months, 8 months, or even a year extra from what we have, have that kind of discussion, but also internally just look at how you're spending your money versus the value that you're creating. So the overall story doesn't change, except we try to impress survival, value creation, discipline, and also trying to, if somebody comes to you and they say, hey, I know you're not raising right now, but I have the money, or just sort of selectively bringing in new partners right now that are looking to already extend a long runway. I would say the one thing that we tell people that is much more context is inflation. So because we invest in consumer businesses, and I think that a lot of spending didn't necessarily go down because of that post-pandemic vengeance spending. But I think now we're going to just see people tightening their belts a little bit. So if you're selling a consumer product, maybe you need to think about how to navigate higher prices and elasticity of demand. That's really, from a context perspective, what we are telling our companies.
That's awesome, man, and I appreciate that as well. And I want to talk a little bit about, just kind of looping back around your story. You came with very humble beginnings, and now you've done very well with where you're at, and obviously you're hitting up to the right, massive trajectory even further. And so, quote unquote, right, like the American dream, right, success. And David, I want to ask, during your journey, what do you believe are some characteristic traits that you feel like you possess that has helped you facilitate the lifestyle that you now have and the success that you currently have?
Wow, yeah, that's a packed question. That's loaded. Yeah, I mean, I think a few things. I think authenticity matters. I think most of what you do comes from who you are. It sounds like a cliche, but I think that at least in my personal life, I was sort of like restless until I found a space where my form would fit, something that had the purpose that's aligned with what I want to do, the values, and also that is aligned with my skill set. So I think when I came to the US, I went to work on Wall Street because most of my friends were doing that. And the firms came to recruit at my school. But then the second stage is to sort of assess that and say, is this who I really want? And that takes a lot of two things, introspection and understanding yourself and knowing what, and humility and honesty, but also it takes courage. I'm actually trying to write something on my blog, which I don't write as often on, about this concept I call off ramps. So there's obviously a highway and everybody's going in that same direction. And then you sort of choose your exits. So you have to sort of like decide, okay, I want to now get to the right so that I can get on this off ramp. And off ramps are places or junctions in your life where you make decisions that are different from others. So when I was in high school and I was coming to college, I had acceptances from other colleges, and I really wanted to study finance and accounting because that's what I grew up being told you should do. And then I sort of met some people, and they, mentors, and I just listened to them. And they said, hey, why don't you go to Middlebury and study liberal arts? And I was like, what is liberal arts? They're like, you need to read a lot of books, and then you just learn a lot of topics. It's just general studies, and you could become smarter. And I was like, okay, I'll do that. And I remember my parents were so upset. Some of my friends are like, I can't believe you're getting a scholarship to go to the US and you're gonna like study like liberal arts and math and stuff. Like, why don't you go study actuarial science or finance to become really an expert? But right, and then the second one was when I was leaving business school, and I had offers to join other very traditional firms, and I decided to go join a family office that was just getting started in the venture business that nobody really knew about. But I had all these other options, and they were not really paying me that much, but it was a platform that had capital, that had similar values of putting capital where your values are. And there were people that I respected and liked, and it was a very small team. We were like 4 or 5 of us. So I said, I'm going to go join here and play with real money so that I can teach myself how to do this business in the future. And a lot of my friends are like, I can't believe that you're coming from Stanford Business School and you're going to like join some no-name, like, family office. So those kinds of like decisions. And then the latest one is basically leaving my old job to start Fairbridge Park. And people are like, wow, this is such a comfortable life. You're like living and working in Connecticut. These are like really nice people. You could write this and save a lot of money. And I was like, well, no, I think I would like to now go and start this business. So you always have to assess the situation, know what you want to do, and be comfortable taking these off ramps, which maybe people look at and they say, this is completely very badly thought out. But have confidence in yourself, have a plan, give yourself time, and just be courageous to jump off that highway.
David, I like that approach. And let me ask you, what has helped you keep the path, keep the courage, keep the confidence to ensure that, hey, you know what, you are on your path and you're not living someone else's dream?
Yeah, I think the number one thing is just you know, you have to have a certain something that is bigger than you that you're trying to do. So, right, there's got to be something that's bigger than you that you're trying to do. You have to sort of embrace it and understand it and live it. You know, for me, I'm sort of like in some ways a person of faith, so I understand these concepts from a bit of a religious bent, if you may, because that's kind of what they're always telling you, like what's bigger than you and what's out, you know. And then I think you need people. I've been very fortunate to have mentors, sponsors, and some of the things that people have done for me. Like if I tell you, you'd be like completely, you'd be like surprised. And I always tell people that the angels are walking among us. So that some people that have completely transformed my life, a mentor that got me a job on Wall Street, and a mentor that got me a job on Wall Street when I was a sophomore in college, and another mentor that really took me by hand and really helped me to apply to go to business school. My old boss at my old firm, who basically just was sort of like another father figure in my life, sponsoring me and actually invested in my fund, was the first investor in my fund. So they're just people in my advisors in my current business. So they're just, you know, people want to help and people want to get behind people that want to do things. So you need to have people. And thirdly, I'll just say having a certain type of routine, things that you do to manage stress. It's very stressful to build a business. It's very stressful to want to do something big. It consumes you, you know, it sort of becomes all consuming. So I'm a long distance runner. I exercise a lot. I like the arts. I spend a lot of time at the Blue Note down here in New York at Dizzy's Jazz. I go to a lot of like concerts. And so if I did not run or do the level of exercise that I do, I probably would be like a little crazy. And if I didn't have all these other things that I'm doing on the side, I probably would be. So I think just having a certain very strong sense of values and where you want to play, and having people around you that you really just go to and ask for help, and seeking out those people, and then having a structure. I remember one of my mentors saying, you know, the structures that we create in good times will be the structures that support us in bad times. So if you have a structure, you can lay on it when things are really not going so well. So that helps.
You know, David, I appreciate you being authentic and sharing some of those things and the characteristics, traits that have helped you, you know, go on those off ramps and follow that path, and you know, embrace that uncomfort, and embrace the unorthodox way of doing things sometimes, but going out there and pursuing what you know is right. And it's always interesting to see, you know, hear that journey, but also hear the serendipities of how it goes. You know, like the right individuals that, you know, invest into your fund and invest into these things, and et cetera. And you know, I think it's individuals like yourself that go out there and see the impact side of things, and you know, the environmental, the health and wellness, the side of things where you know, you really want to see a huge, you know, exponential growth. And you know, because you go out there and follow your dream and you help these other founders raise capital, and then they go out there and impact consumers, and it's that serendipitous kind of exponential side of things. And I really appreciate you being on here, man, and also unpacking your thesis, your portfolio, the way you look at this. I know you're a very smart individual looking at data and, you know, analytics and trajectory and all that fun stuff, the metrics, and, you know, just, you know, sharing your thoughts, sharing your perspective, sharing the way you analyze data at a very deep level and a micro level. I really appreciate you being on here, man. And for those that want to reach out, that maybe want to invest into your thesis, that are very impact driven as well, or just really, you know, love your story and they want to follow you and consume more of your content, David, how do they reach out to you, my man?
Yeah, I mean, the best way is to send me an email. I'll give you my work email. It's just david@fairbridgepark.com. I will respond. I'm notoriously known to respond to everything that I receive. On LinkedIn, on email, I do not leave any stone unturned, because you just never know. You never know. I'm a big believer in serendipity, in non-missed connections. So I'll be happy to connect with everyone. I also actually have a blog. I haven't been writing on it for a while. It's called goodcommercialsense.com. And I also just write from time to time on LinkedIn. And one of my goals this year, Christian, is to be more like you, is to be more consistent in producing content, in bringing together people that have similar values, and creating a strong network of people that believe in some of these things that we're doing. And I'm happy that you invited me to your podcast, and now going forward, I'm part of your broader network.
Awesome. And guys, those links will be in the description below. I'll put his websites as well as LinkedIn. And then David, I really appreciate making yourself so available. I'll put his email down there as well for those that want to contact him directly. And like you mentioned, he is very responsive in that regard. So I really appreciate you making yourself so available. And guys, that is my friend, the managing partner at Fairbridge Park, the one and only David Tswamuno. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.